Hello, fellow Rebel Capitals. Hope you're well. So we've got big news coming out from the big man himself, Donald Trump. You all know how he was calling for interest rates to go down by 300 basis points. One move, 3% down. But now he's taking it to a whole nother level. And we got to combine this with the fact that many insiders in the White House are saying that he's right on the brink of firing Jerome Powell. And then we have to ask ourselves the question, what if this plays out? What if he does it? What if he gets in a yes man and the yes man not just drops rates by 3% from 4.25 to 1.25, but what if they drop rates even further? And you say, oh, George, this is just crazy talk. Oh, is it? Let me show you this headline from Fox News. Right here. Trump calls Fed Chair Powell a knucklehead. No surprise there. Says interest rates should be below 1%. So let's go over to the Fed funds rate right now, just to make sure we're all on the same page. We'll go, 5-year chart here. So Fed funds, and this is really the only part of the curve they control. It's more the front of the curve. They control the curve. Does the Fed funds rate have an impact? Sure. The question is to what degree, and the overriding factor, as you guys know, is going to be growth and inflation expectations, especially at the long end. But the overnight rate, the Fed funds rate, the Fed funds effective rate, FFR, back in 2021, basically 0%. And then Powell raises rates. We know that. They pause like every other cycle, and they come down by 100 basis points. And then they've hit the brakes since then. So currently we're at the bottom of the range is 4.25%. So like I said, if we go down to 1.25, this would be Trump getting the 3% drop that he said he wanted. But now I think he's getting more, there's more hubris here. He's getting more confident. And the closer he gets to potentially firing Jerome Powell, which was the big story yesterday, it seems like the level of interest rates just gets closer and closer and closer and to zero. And by the way, he says should be below 1%. What does that mean? Does that mean 0.9? Does that mean 0.5? Does that mean 0? Does that mean negative interest rates? I mean, if you sat Trump down with no media and asked him, hey, would you like to see negative interest rates right now in the United States? I almost guarantee you he would say yes, because you love Trump, you hate him, whatever. The bottom line is he's very explicit in his views on interest rates, and he thinks whatever country has the lowest interest rates, well, they're winning. And the lower the interest rates, the better. Because if we have negative interest rates, then you're paid to borrow, and then we can really bring down the interest payments on the debt. I would almost assure you this would be his line of thought. So now we ask the question, what happens if he does fire Powell? It's not a certainty by any stretch of the imagination, and the market is not pricing that in. Not pricing it in. Let me show you what I'm talking about. We go to July, and by the way, this is the CME group. This is FedWatch. So this is the market's predictions or odds on where interest rates will be at a certain point in time in the future. So we fast forward to July 26, so a year from today, and the market's, the highest probability here is for 3.25%, 325 basis points. So this is the market saying we think there's a 28% chance that the Fed funds rate fast forward a year is going to be 325 basis points or 3.25%. So we go down to the far left, the lowest on this scale or on this chart, and this is 2.25%, 100 basis points above where Trump wanted them a few weeks ago, but well above the negative interest rates that he could be implying by under 1%, and that's only a 0.4% chance. So if you went to under 1%, we're looking at as close to a 0% odds as you can get. And this is what the market is saying. But then on the flip side of the coin, we are talking about Trump. And love him or hate him, you've got to admit that he is very unpredictable. Whether you think it's just buffoonery, whether you think it's incompetence, whether you think it's hot-headedness, whether you think it's 5D chess, regardless, the one thing we can all agree on is Trump is very unpredictable. So would I, even though the market is attaching almost a 0% probability of him firing Powell and getting in a yes man that would take rates way down, I just Trump being Trump, I would not put that at a 0% probability. I would put that probably closer, I don't know, 15%, something like that. That would be where I would put my money. So now I want to keep that in context because I know a lot of you are probably thinking, okay, so what? If he wants it down below 1%, 0.5, that's right where we were in the cerveza sickness. It's not so much the nominal level of the Fed funds rate. Like we go back to our chart and I zoom out and this whole span right here after the GFC, we're basically at 0% interest rates. Ditto that for after the cerveza sickness. The unprecedented part of that would not be the level of interest rate. It would be the amount of the cut, the how extreme the cut was. So I went back and actually did some research, believe it or not, and I found the biggest cut the Fed has ever done is 1%. That's the biggest cut, the largest cut. And that was once during the GFC and once during the cerveza sickness. So think about that. Trump is demanding a 3x or more from it. Or who knows? Maybe, he says below 1%, that could be 4x. Where from cut from what we've seen in the past as far as the most extreme cut. That was the most extreme cut before. And Trump wants at least 3x. So even if it's a 10% probability, you have to then say, okay, what would happen to the dollar if this plays out? What would happen to the 10-year Treasury yield? What would happen to the economy? What would happen to gold, for heaven's sakes? What would happen to silver, crypto? What would happen to the S&P 500? And that's where it gets really fun as far as the thought experiment. So let's go into that right now. I actually did this this morning for a whiteboard video, so it's kind of fresh in my mind. First, let's start with the 10-year Treasury yields. Now, right off the bat, if I asked you guys watching this video right now, what do you think would happen if if Trump fires Powell, gets in a yes man, like let's say Scott Bessent, and Bessent immediately drops down to 1% Fed funds? What do you think would happen to the 10-year Treasury yield? I think people's knee-jerk reaction would say, well, the 10-year Treasury yield is going to plummet. The entire curve is going to plummet. Maybe. Maybe not. I would direct you to September of 2024. We all remember this. This is when the Fed started cutting rates, and they cut rates not one time, but over the span of a few months, they cut rates by 100 basis points. I don't know where there we go. Zoom in right here. So this time, September, over the next few months going into December, they cut by 100 basis points, basically from 5.25 to 4.25, the low end of the range. So during this time, well, obviously, the 10-year Treasury yield went down by 100 basis points, right? Wrong. The 10-year Treasury yield actually went up by 100 basis points. So there was a 200 basis point swing between Fed funds and the 10-year Treasury. So how on earth did this happen? I thought the Fed controls interest rates. No, the Fed controls the overnight rate. But what controls the long end of the curve, which I say till I'm blue in the face on this channel, growth and inflation expectations. So if the Fed is cutting and as a result, the market expects more growth or inflation, the 10-year Treasury is likely going to go up, not down. Now, if the Fed is cutting, usually as a reason or as a result of the stuff hitting the fan, so let's go back to right here. Let's zoom out. So right here, if the Fed is cutting like Q3 or Q4 of 2008, then what's the 10-year Treasury yield going to be doing? It's going to be tanking. It's going to be tanking. Why? Because regardless of the Fed cutting, the market is expecting a lot lower growth and inflation expectations. So if I had to give you my base case as to what would happen to the 10-year Treasury yield, assuming Scott Bessent gets in there and drops Fed funds down to whatever, call it 1%, I think it's a coin toss, because I would have to know whatever point in time that is in the future. I would have to know what the market expectation is currently for growth and inflation. So as an example, I'd have to know what the unemployment rate was. I would have to know what non-farm payrolls were. I would have to know what's happening in the labor market. And let's assume the labor market was heating up. At least that was the perception within the mainstream media. And then Bessent does that. I'm calling for higher interest rates. But let's assume that the labor market continues to soften at the same pace that we've seen over the last, call it, couple months. Then I think the 10-year Treasury yield would go down. Now, it wouldn't go down by 300 basis points, but I think it would probably go down by maybe 50, 100, something like that. I think you'd see a bull steepener, but it wouldn't go down as much as the front end of the curve. Now, the other scenario is the labor market is completely falling off a cliff, just plummeting. Then the Fed cutting down to even 0%. I think 10 years still goes down to, call it 2%, something like that. So this is really difficult to predict or really have an opinion on one way or the other, because you would have to know the attitude of the market, therefore what the data is going to be at 2, 3, however many months in the future, assuming that this plays out. And that's Jerome Powell being replaced by a yes man like Bessent who immediately drops rates. Okay, now then what happens to the economy? Okay, well, let's look at this. This is real GDP, broad proxy for how well the economy is doing. And as you guys know from watching my videos, Q1, we had a negative number of 2025. Now, there's a lot of reasons we could have seen this, a lot of things that some people would consider abnormalities that we might not see in the future. But taking this number in and of itself, this is bad. This is not good. And so would this reverse if we were, all else being equal, if we were able to take rates right back down to 0 or 1%? I don't think so. I don't really think it would impact the economy that much, and I'll tell you why. Let's go over to the yield curve. So this is front end. Obviously, we go from the overnight rate, Fed funds, to the 30-year. And notice it goes up to about 2 months and then starts going down. But after about the 6-month maturity, we go down to where it's under Fed funds. So the curve is inverted when you look at 2-year, 3-year. So if the Fed, let's just keep it simple. Let's say right here drops down to 3.8%, so 3.75 in the next meeting. So we get a 50 basis point cut. Would the 2-year and the 3-year just absolutely plummet? With a 10-year plummet? I mean, maybe. I think they'd go down a bit for sure, but they definitely wouldn't go down by the 50 basis points, all else being equal, right? Assuming that the outlook for the economy at that point in time is the same as it is today. I don't think you'd see an extreme move. And if you don't get that extreme move, if the biggest move is at the front of the curve, like how many consumers does that actually impact? Some, but not as much as the 10-year Treasury, because now we're talking about car loans. We're talking about, I think most of those are tied to 10-year, maybe a little bit earlier maturity. But obviously mortgages, and that's a big one. That's the biggie for sure. So the majority of the super important interest rates in the real economy are kind of predicated upon or tied to, in a way, to the 10-year Treasury yield. So if that doesn't move or doesn't move much, even if Fed funds is going down, then I don't know how that really impacts the economy. You could say, well, it's helping some corporations roll over their debt. Okay, I agree, but I don't know if that's going to have a massive, massive impact on real GDP and economic growth. So the 10-year Treasury yield, I think that's a coin toss. With this, I think the economy is going to do what the economy is going to do. I don't know that the front end of the curve would really do much to kind of stoke or to be stimulative. And we've never seen that in the past. Like if we go back to Fed funds here, just show me the interest rate cut right here that stimulated the economy. Or in other words, show me the interest rate cutting cycle that resulted in the economy improving or growing, rapidly. You could say that it stopped the economy from complete and total and utter collapse. Okay, that's a good argument, right? But saving it from total and complete utter collapse, I don't know, is the exact same thing as stimulating substantial growth. A little bit different there, a little bit different. So now we get into, so those were the kind of hard things to figure out. What's super easy to figure out is the dollar, gold, and stocks. So let's go over to long-term chart of the dollar. Right now we're at 98.64, which you can see is kind of in the middle. It's not really low, not really high. If we go back to call it the early 90s or so, I guess it's on the high of the range there. But a lot of this is, especially in the short term, is interest rate differentials between the Fed and the ECB. The ECB is pegged right now at about 2%. Peg's not the right word. They're paused at 2%. But if Powell's gone, Basset's in, and he drops to 1%, whoo, talk about an extreme move in interest rates. So right now you got the Fed at 4.25. You got the ECB at 2%. Imagine if the Fed just drops all the way down 300 basis points in one move. The dollar would truly just tank. I mean, that's the best word I can use to describe it. Now, would it go down to the same levels that we saw in 2010, down to low 70s? I don't think so. It would probably go to mid 80s, 85, something like that. That I can say with a high degree of confidence. No certainties, only probabilities, but I would peg that at probably about a 90% probability. Now, over the long run, does that really control the DXY when we're just using it as a proxy for the dollar? No, that would be the global monetary system. That would be the overriding factor. But over 3-month, 6-month, even year span, those interest rate differentials can really be a strong headwind or a strong tailwind, especially if it's so unprecedented and extreme like what we're talking about today. So the dollar, that's an easy one. Gold, that's probably just as easy. Let's look at a chart. So gold right now trading at 3,346. Gold would basically be the inverse of the dollar. It doesn't always play out that way, but dollar would tank and gold would just rip higher. I would not be surprised if gold went straight to 4,000. I mean, it would just moon. I mean, it'd be like Buzz Lightyear to infinity and beyond. I would say the exact same thing with Bitcoin. I don't know where we are right now on Bitcoin, but right around 119. And as far as the stock market, ditto. Exact same thing. It would just go straight, especially the Nasdaq, because that's a little more interest rate sensitive than the S&P 500. All right, guys. So the next question becomes, how on earth do you navigate this crazy, insane world we're living in right now? And you know what's funny is I just tweeted this out. Zero Hedge showed how the um, 0 day expiring options, forgot what you call those. Basically, this is just a complete gamble. They showed how they're at all-time highs, and it's representing about 2/3 of the overall volume in the option market are these zero dated or zero expiring options. And their takeaway was the stock market has completely turned into a casino. I totally agree. I think almost every single one of you guys watching right now would have that same view. But what's fascinating to me is how we all know the stock market's a casino. We all know how the stock market is wildly overvalued based on where it historically is. But if you tell someone, I don't own the S&P 500, I own, let's say, gold and treasuries, they laugh at you like that kid on The Simpsons. Ha ha. I forgot what that kid's name is. Like the bully kid. I love that guy. Ha ha. Nelson, I think his name is. They laugh at you like Nelson and they say, ha ha. Looks like you've missed out on all these gains, idiot. And you're like, I don't know. I mean, gold's gone up quite a bit, probably more than the stock market. And I've been getting 5% on the rest of my portfolio that's in treasuries. And it's not just about the reward, it's about the risk reward, right? So am I smart, quote unquote, if I load up on the S&P 500 knowing that it's a casino and knowing that valuations are at nosebleed levels and it's extremely overvalued? I don't know if that's a smart move. And I think most of you on this live stream right now would say, yeah, maybe a portion of my portfolio in the S&P 500, but I'm not going all in. Uh, I'm very cautious at this point in time. So for those of you who fit into that category, I just started a free newsletter weekly. It's just basically a summary, or my summary of what happened in Rebel Capital's Pro, and that's the investing community I have with Lynn Alden, Chris McIntosh, Brent Johnson, Patrick Srezna, Jason Hartman. And Josh will go ahead and put a link in the description of this video, maybe in the chat, how you guys can go over there. And it's just a way for me to build the email list. So you go to a page that will look like this. So all of us at the top here, and you can just put in your first name, last name, email, and then just hit get Rebel Capital's Pro report. And I'll send that to you weekly. There's going to be one that goes out tomorrow, Friday. And I can assure you, I manage this, and you don't have to worry about spam. You don't have to worry about me giving your contact information to any third party. Do not worry about that at all. As you guys know, I'm someone that's definitely an advocate of privacy, to say the least. So if you want to check that out, again, it's free. You can just put your email address here and check your email, your inbox tomorrow, because you'll get one of these Rebel Capitalist Pro reports. All right, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism, and we'll see you on the next video.